In 2025, the world of finance is grappling with a concept that has moved from the fringes to the very center of debate: ESG. This acronym stands for Environmental, Social, and Governance. It is a framework used to assess a company's performance beyond its balance sheet. The E looks at a company's impact on the planet, such as its carbon emissions or water usage. The S examines how a company manages relationships with its employees, suppliers, customers, and the communities where it operates. The G scrutinizes a company's leadership, from executive pay to internal controls and shareholder rights. It is a way to measure the non-financial factors that can still have a very real impact on a company's long-term success. The importance of ESG has grown because investors and companies now understand that these factors represent both risks and opportunities. A business that ignores environmental regulations could face hefty fines or lose customers who care about sustainability. Similarly, a company with poor labor practices might struggle with high employee turnover and damage to its brand reputation. Good governance, on the other hand, can prevent scandals and ensure a company is well run for the future. By 2025, ESG is no longer just about feeling good. It is about making smart, informed decisions that protect investments and create lasting value, a principle that is becoming embedded in mainstream financial analysis. This year, ESG is less of a buzzword and more of a complex reality. The initial excitement has been replaced by a more mature and critical approach. Investors are asking tougher questions about what ESG labels really mean. They want to see clear, reliable data that connects ESG performance to financial results. Companies, in turn, are moving away from vague promises. They are focusing on the specific ESG issues that are most material to their industry and business model. For example, a tech company might focus on data privacy, social, while an agricultural firm might prioritize water management, environmental. This shift shows that ESG is evolving into a more sophisticated tool for risk management. The conversation around ESG in 2025 is also deeply polarized, especially in the United States. While some see it as a responsible way to manage modern challenges like climate change and social inequality, others view it as a political agenda that distracts from an investor's primary goal: maximizing financial returns. This tension has created a complex landscape where the path forward is not always clear. The debate forces everyone involved, from asset managers to corporate boards, to be more precise about their goals. It has pushed the industry to refine its methods and prove that considering ESG factors is not just ethical, but also financially prudent for building resilient portfolios. The global growth of ESG investing presents a fascinating yet divided picture in 2025. Europe remains the undisputed leader, holding a remarkable 83% of all global ESG fund assets. This dominance is not accidental. It is the result of a strong regulatory push and a widespread cultural acceptance of sustainability principles. The European Union's Corporate Sustainability Reporting Directive, or CSRD for example, is a powerful force. It requires thousands of companies, including many multinationals, to provide detailed reports on their ESG performance starting in 2026 for their 2025 data. This has created a market where transparency and accountability are not just encouraged but legally mandated, driving ESG integration deep into business strategy. In contrast, the United States is a patchwork of conflicting ideas and regulations. At the national level, the political winds have shifted. The current administration is showing signs of scaling back federal support for ESG initiatives. For instance, the Department of Labor has announced plans to reconsider a rule that allows retirement plans to consider ESG factors, and the SEC has paused the defense of its climate disclosure rule. This federal retreat has created uncertainty and emboldened critics who argue that ESG goals can conflict with an investment manager's duty to prioritize financial returns. This has led to a more cautious and fractured market compared to the unified European approach. Despite the federal headwinds, many U.S. states are forging their own paths. A clear divergence has emerged between states that support and those that restrict ESG. States like California, Illinois, and Maryland have enacted rules that encourage or even require ESG considerations. California's landmark laws, SB 253 and SB 261, mandate large companies to disclose their greenhouse gas emissions and climate-related financial risks. These blue states are creating regional ecosystems that closely resemble the European model. driven by the belief that sustainability is crucial for long-term economic health. They are effectively creating their own standards in the absence of federal leadership. On the other side of the divide, a growing number of states are actively pushing back against what they call woke capitalism. As of early 2025, around 19 states, including Texas and Florida, have passed laws restricting the use of ESG criteria in state investments, particularly targeting boycotts of fossil fuel industries. These red states argue that asset managers should focus solely on maximizing financial returns for pensioners and taxpayers. This pushback has created a complex compliance maze for large financial firms that operate nationwide. They must now navigate a landscape where an investment strategy that is celebrated in one state is restricted in another, highlighting the deep political polarization shaping the future of ESG in America. The year 2025 is defined by a significant increase in legal and regulatory scrutiny surrounding ESG investing. The term ESG itself has become a lightning rod, attracting litigation and political pressure from all sides. In the United States, asset managers are caught in a difficult position. On one hand, they face lawsuits from states like Tennessee, which sued a firm for allegedly misleading consumers about its ESG funds. On the other hand, they are being challenged by those who claim that prioritizing non-financial ESG goals violates their fiduciary duty to clients. A recent court ruling found that an asset manager was liable for prioritizing ESG in proxy voting, sending a chill through the industry. This heightened legal risk has forced many large financial institutions to rethink their public commitments and collaborations. Fearing antitrust lawsuits and political backlash, major asset managers have begun exiting high-profile climate coalitions like Climate Action 100+ and the Net Zero Asset Managers Initiative. House Judiciary Committee reports have labeled these collaborations as climate cartels, raising concerns about anti-competitive behavior. This retreat does not necessarily mean firms are abandoning their ESG principles, but it does show they are becoming much more careful about their language and legal exposure. The focus is shifting from broad, collective pledges to more discrete internal risk management processes. Beyond the political battles, a quieter but equally important trend is emerging: a relentless focus on data quality and materiality. Investors are no longer satisfied with glossy sustainability reports. They demand hard evidence and standardized metrics to back up ESG claims. This is where technology, especially artificial intelligence, is playing a bigger role. AI-driven tools are now used to sift through vast amounts of data, from satellite imagery tracking deforestation to news sentiment analysis, helping investors identify genuine ESG leaders and avoid greenwashing, the practice of making misleading claims about environmental credentials. This data-driven approach is making ESG analysis more rigorous and objective. The concept of materiality, focusing on the ESG issues that have a direct financial impact on a business, has also become central to the conversation in 2025. Instead of trying to be good at everything, smart companies are identifying the specific environmental, social, and governance factors that pose the biggest risks and opportunities for their particular industry. A food and beverage company might concentrate on sustainable sourcing and water scarcity, while a software company focuses on data security and employee well-being. This pragmatic approach moves ESG from a public relations exercise to a core component of corporate strategy and risk management, making it more resilient to political criticism. Looking ahead, the future of ESG investing appears to be one of transformation rather than disappearance. The very term ESG may fade away, not because the principles are irrelevant, but because they are becoming so deeply embedded in standard investment analysis. What was once considered a niche or alternative strategy is now being integrated into the mainstream understanding of what constitutes a well-run, resilient business. Investors are realizing that ignoring climate risk, poor labor practices, or weak corporate governance is simply bad for business. In this sense, the goals of ESG are merging with the traditional goals of fiduciary duty to secure the best possible risk-adjusted returns over the long term. The debate over ESG is forcing a necessary maturation of the market. The political pushback and legal challenges are weeding out weak strategies and unsubstantiated claims. Major firms like BlackRock are already closing underperforming ESG funds to focus on quality over quantity. This survival of the fittest dynamic means that the ESG products that remain will likely be more robust, transparent, and clearly linked to financial performance. Investors will demand better data and clearer methodologies, and asset managers will need to provide them. This leads to a more sophisticated market where ESG is treated not as an ideology, but as a critical source of financial insight. Ultimately, the trajectory of ESG will likely be less about politics and more about pragmatism. The core drivers behind it, such as the financial risks of climate change, the importance of human capital, and the need for strong governance, are not going away. Global regulations, especially the far-reaching rules from the European Union, will continue to push multinational corporations towards greater transparency, regardless of the political climate in the United States. Companies that operate globally will have to adapt to these higher standards, and that data will become available to all investors, further integrating ESG considerations into global markets. In conclusion, while the ESG landscape in 2025 is fraught with challenges, from legal risks to political polarization, the underlying movement is not likely to be derailed. Instead, it is evolving. The focus is shifting from labels and promises to data and performance. It is moving from a separate category of investing to an integrated part of how all sound investments are analyzed. The future of ESG will be defined by its ability to demonstrate tangible value and manage real-world business risks. It is becoming a more durable, sophisticated, and essential part of the financial ecosystem, proving that responsible investing and smart investing are increasingly one and the same.